Hello, and welcome to Pro Trader Strategies Market Commentary for Wednesday, June the 29th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. It's a pretty substantial amount of economic data coming out today. In German, we had the CPI number come in line with expectation. Spanish flash PM, that was German CPI, came in line with expectations at 0.1%, and Spanish flash CPI came in at negative 0.8%, but that was better than expected, the negative 1% by economists. We also got, here in the United States, we got core PCE price index, which is the personal consumption expenditures, which is considered to be the number that the Fed really looks at because it really targets the consumer expenditures, or the consumption, I should say, of the consumer. It really targets them, and that is why the Fed looks at that more so than the CPI number that we got about 10 days ago. We also got personal spending that came in line with expectations here in the United States of 0.4%, was expected 0.4%. Personal income came in at 0.2%, which was expected to increase by 0.3%. And we had pending home sales, which was the worst number we've seen for pending home sales since like 2014, so quite some time. It came in at negative 3.7%. So that number would think maybe cause a little bit of downward movement in the overall equities, but the overall market is rallying. We might be back to bad economic data is good economic, or good for the equities, I should say. We also got crude oil inventories, which was a drawdown of 4.1 million barrels, which was expected to be 2.3 million barrels. So that has caused crude oil to get some legs and is up over $1, about $1.25 right now, and is testing the value area high here, as you can see. So we're pushing up against that. It'll be interesting to see if we can get through that. The real line in the sand, as I've been talking about for some time, is that $50 a barrel area, and we're about 87 cents away from that. So on to the overall equities. Equities are following lockstep with the crude oil rally, and as you can see here, pushing right through this value area or point of control, which is the magnet I've been talking about when we came down and tested and rebounded off of that value area low. The overall market I was talking about looks like it was going to want to at least come back and test the point of control, and we are there and actually pushing right through that right now as we speak. As you can see here, NASDAQ /NQ up over 67 points right now. Onto the E-mini S&Ps. As you can see, we're pushing up into that point of control area. Most time and volume spent right around in this area. You know, there's a little bit of separation there, but at the end of the day, that is the magnet that we've been talking about, the market wanting to retrace to, and up 28, almost 29 points right now on the E-mini S&Ps. As you can see here, a lot of people are talking about on social media and other places that we are back above the area of the Brexit, but as you can see, the in that they're talking the day session. So although there was a gap down in the morning, we've retraced that part, but this is really the Brexit voting that was going on. London right here is where London voted to remain, and that caused that market to rally. But this is really the area we need to retrace to get to the levels of before the Brexit vote, in my eyes, because this actually happened overnight, because the E-mini S&Ps are trading for like 23 hours out of the day. So that was all happening during that voting and how it was coming out live. So that's really where it needs to retrace to if people want to say that we have recaptured the losses seen on the Brexit vote. Gold also, these are a couple of little strange things that I've been noticing. Gold's still rallying, pushing higher off of all of this. The other thing is the bonds are continuing to push higher also. So that should signal a bit of a warning here to all of the equity bulls is, bonds should be wanting to sell off with this big rally. So that's something to keep your eye on for sure with this bond rally, who's right and who's wrong, because usually they are inversely correlated. So we'll have to see. I'm having an itchy trigger finger because, as you guys know, I got out of my short SPY and a few other shorts and got long on this pop. So I am going to have a quick trigger finger to cover some of that because I am very long deltas in my portfolio. I think I only have a few positions that are short deltas. So I'm going to need to start adding some short deltas or covering a lot of those long deltas. And it's looking like right now I need to cover some of those long deltas just because the overall premiums have come out of those with the volatility contraction that we've seen in a lot of these markets. One thing I did with Comerica was I had on a July 38.48 strangle in there that I originally collected $1.18 for. So now with the sell-off, as you can see, my 38 puts were tested, and I decided yesterday when this was starting to rally that I needed to cover the calls. Now I only do this every so often when we start seeing these big gap downs and the market moving a little bit erratically. The theory is to roll those calls down, collect a little bit more premium, but I felt that the market was going to pop back higher, then that would have hurt me. So I just decided to cover those 48 calls for 3 cents. So that does increase my risk a little bit in the sense that 3 cents, which takes away from some of that $1.18 credit. So it's really now a $1.15 credit, right? So it did increase my break even on the downside a little bit. But at the end of the day, if the market really started popping back like I expected it to, then those calls would start increasing in value, and I didn't really want to see that for 3 cents. It just didn't make a whole lot of sense to me. So I covered those. I'm still short the 38 puts and essentially legging out of that strangle, which I talk about not to do, but in this situation, it seemed to be the right time just because of that massive move down, and I thought it was a little overdone. Then with Apache, I have on a strangle in there as well, and with Apache, with the sell-off, I just decided to go in there, and with the market coming back, to go in and sell some puts. And I did the July 50 puts, and I sold them for 59 cents. So those last two trades I did yesterday and eBay as well. But yesterday I sold those 59 puts, sold those 50 puts for 59 cents, which helped, increase my break even on that strangle just a little bit. But it did increase my risk to the downside, so keep that in mind. And then in eBay, I had just a couple of days ago sold the July 21.5 puts for 31 cents and was able to, with the volatility contraction and the correct market movement, get out of that naked put for 16 cents. So I made 50% of my max profit on that, which is one of the guidelines I use. IBM is very close to that also. So a lot of those that I put on just a couple of days ago on like the 27th are directionally right, and the volatility contraction has helped speed up that process of being able to get out of those for 50% of the credit I received. So that's the goal here for that. And then in the Qs, this was a strategy that actually went against me. I did this as a 2x1, and the strategy I did a webinar on. This is a front ratio spread, so it's going to be collecting a credit for it. And I had on the July, I sold the 104 puts, and then I bought the July 107 puts. And for every 104 put that I sold, then for every 2 of the 104 puts I sold, financing the 107 puts I got long. So that did go against me, as you can see, quite a bit. Today it came back in to the range there, and I didn't really want this to rally too far to those 107s, so I was getting a little bit nervous. So right off the bat this morning I decided to cover that strategy. Originally I collected 34 cents for that, and then I got out of it for I originally collected 15 cents for that strategy, and then I covered it this morning for 34 cents. So all in all, I collected 49 cents for that total strategy. And that's the key to do that. I mean, it was a loser for a little while, went below my break even, but again, I was under that assumption. This was just a little bit overdone off that Brexit talk, and now the market coming back is quite nice, and we are right there at the value areas, if you will. So that's why I decided to cover that as well, the magnet. That's about all I got for you guys today. Friday's webinar is going to be on a poor man's covered put, which is a great strategy, especially for people that have the tendency to get very long in their overall portfolio. They can probably now understand after this big sell-off why there is the need to have short deltas and get short some underlyings in the portfolio, because you don't want to be beholden to any one market direction being up if you are just long those overall equities in your portfolio. This is going to be a way to create a hedge, maybe even pair off some different strategies where you're long one stock in one sector and you can get short another one. That's about all I got for you guys today, other than if you can't take that, take it easy.